So thank you for staying until almost 4. Just want to talk about what we're seeing. I'm an investment banker based in New York, one of the co-organizers of this conference. Thank you. Every year we do this market update. What are we seeing in investment trends? What's attractive, not attractive? And then the purpose of this is to show that there's really a sector that is global, that is generating very attractive returns for shareholders and for customers. So we'll start from scratch. The other one, the green one. Okay. I need some training on this. So what's new? And I'll be quick. So you've heard about the job gap and job skills, but just wanted to refresh everybody. In 2015, the World Economic Forum, Davos, put out a list of the 10 skills you need to thrive in your workplace. And some of them you've seen: complex problem solving, coordinating with others. Very interesting. In 2020, I have no patience. That's the other problem. They came up with another list, and I'm going to make it easy on your eyes. In red are the skills that are either disappeared from 2020 or went down, and in blue, the skills that went up or appeared. And then you'll see what's up is critical thinking, creativity, emotional intelligence, and cognitive flexibility, which, connecting it to a panel that the ladies did this morning, a lot of those skills traditionally women are stronger at. And so as you're thinking about it and you think about diversity in the workforce, critical creativity, emotional intelligence, something that guys tend not to be very strong at. And so as you're thinking about this, this is part of the skills gap. We don't have enough people strong at this. Hold on. Missing that one. I'll go very quick on that. A couple of global trends, the skills gap, also subgroup imbalances where you've got gender, racial disparities, and then but you're also complaining about a skills gap. So thinking about that. And then the traditional pathways to get an education, as they get more expensive, whether to access or in dollars shekalim or in time, then you create opportunities for alternatives to emerge. This is the innovator's dilemma. In some regions of the world, you have a rising middle class that now wants to buy education and is thinking of it as a consumer, like Amazon. Years ago, you couldn't rate your education online and get a 4-star or 3-star, but now you can. And so there's a different behavior. I won't go into the technology, but it sort of levels the playing field. A lot of the solutions we'll talk about, they all have some of those things in common. Velocity, how quick you get your skills, personalized, gamification, how engaged, a lot of the skills, you have to be engaged. They're immersive, and then they're affordable. This is a bit of a quiz. This is a stock graph of public companies, which we grouped into subgroups. And if you look at this, there's one that stands out, and I'm going to do the big reveal. It's Talent Tech, which grew over 40% in the last 12 months. And then the NASDAQ is the dotted line. And then there's a bunch of other subgroups, which I'll go into in a minute, that sort of underperformed the NASDAQ. And even in those subgroups, you'll see their differences. Start with the content, and that's sort of fairly generic way of regrouping the companies. But you've got the traditional content owners, Pearson, Houghton Mifflin, and John Wiley, public companies. They're sort of trading on a multiple of EBITDA, 5 to 7, 5 to 8, and none of them have sort of breakaway. We're seeing John Wiley making an interesting play moving into online program management, but this hasn't been reflected in the stock price yet. And we look at the labor intermediaries, the typical temp agencies, and they're trading in a very narrow band, in the 7 to 8 times EBITDA. There's nothing new there. What's interesting is all of them, I call them intermediaries because they take labor and they place it. And they're realizing that the business model is not sustainable, and they're going to have to start manufacture talent, which means train and retrain and identify skills, people that have skills that can be repurposed. Adecco last year bought General Assembly for $400 million. It's a big price, but it's a small part of Adecco for now. So we think we're going to see some changes in the next couple of years because they have to do something. Oh, hold on. Post-secondary, maybe the two things I'll point out there is that you've got Chegg and 2U. Chegg is their end customer is the post-secondary student. They don't think about, it's a B2C model. They don't think about selling to university. They sell services to the students so that they can acquire the skills. Tutoring, job placement, internship, textbook rentals. And as you can see, they've done pretty well this year, but those are not small companies, about $4 billion in enterprise value, trading at about 10 times revenue. Still not profitable. But investors are seeing the future of consumerization of education. And at the bottom, there's 2U, which was the darling of the public markets for the past few years. They're the leader in the online program management. And part of the valuation of the last few years was based on the growth prospects, and investors have gone in skittish around the ability to maintain that growth. I'll talk about 2U a little bit later. But still, $2 billion enterprise value. And then the talent technology, the group overall has gone up 40%. It's a combination of companies like Workday or Pluralsight. I don't know if there's a pointer, but Workday is a $45 billion business, trading at 12 times revenue. They solve a very particular pain point in the enterprise, and they've been able to expand the TAM year after year. And then you've got Pluralsight, which went public this year, or in the last 12 months, trading at 9 times EBITDA. They're the traditional company, but they combine that in terms of content with an ability to pinpoint what skills you need to get and then sell that to corporations. So 9 times revenue. And then at the bottom, just want to point out GP Strategies, which is your old catalog of corporate training and trading on the basis of EBITDA about 8 times. China hasn't had a great year. Some companies have done better, like New Oriental and Tal, if you compare it to the Chinese ADR. Tal has been acquisitive in Israel. They bought CodeMonkey last year. And they bought Ready4, which is a US company, but with Israeli DNA. Just based on time, I'll go quickly. We saw a lot of growth last year, and the momentum keeps going. If you see the dollars invested in education growing pretty significantly, number of deals a bit lower, so valuations and dollars per deal is going up. It is across the globe, China, USA, and outside of China, USA, it's India, and then Brazil, and a little bit of Europe. Most of them are tech companies, except 1 or 2, campus-based. Same thing on the M&A side. Really high volume last year. We're on a good trajectory this year. What you'll see here is like there's almost no transaction, M&A transaction in China, and traditionally M&A are for more mature companies, so you have more of your traditional players. I'll talk about Turnitin and Trilogy in a minute. So I'm going to highlight 3 transactions just for as an example. The first one is Trilogy. I spoke about Trilogy last year in the same session. They had just raised $50 million at a $500 million valuation, roughly the same point last year. What they've done extremely well is they've taken an existing problem and they've worked with the incumbents. working with the universities to provide job skills, job-relevant skills, as opposed to provide them with a degree. And they've done that extremely well. They started 4 years ago, and this year they had about $135 million revenue, quite profitable. They were just acquired by 2U, which we've talked about in a minute. It was founded by John Katzman, who was on stage here last year. 2U has done very well in the public markets, about 30% growth every year. But as I mentioned, the growth momentum had slowed down because it was taking more time to get customers on their platform. And they've looked at Trilogy as a company that could be a competitor, but also could expand their addressable market for them by offering the boot camps for universities. So they just acquired the company for about 6 times revenue, so about $750 million. Another example is Cengage and McGraw-Hill just announced their merger. There's a bit of a story there where they both traditional publishers, both challenged in their core business, trying to go through a transformation to digital. Both have a lot of debt and private equity owners that are looking for an exit. And the natural, thank you, the natural transaction is to merge, combine economies of scale, and then roll out technology investments across the 2 platforms. We've done a lot of work with both of those companies, especially McGraw-Hill over the years, so familiar with them. The merger has been announced and should go through the DOJ in the next couple of months. And then finally, Turnitin and Advance. Turnitin is a company that was started about 20 years ago almost. But they took a very simple problem, plagiarism detection, and where there was no money, but it was using up a lot of time for the professors, and it was very important. And they were able to use technology, AI, and machine learning to do something very simple, which is replacing time with dollars. Once they got a critical mass of adoption and they got a pricing model, they were able to ramp up very quickly. They sold in 2014 for $750 million to Insight, 9 times revenue, but 15 times EBITDA. If you can do the math to tell you the size of their EBITDA margin, they were just acquired for double that price, more than double that price by Advanced Publication, which looked at it as a very defensible company. It should have been an Israeli company, if you think about it. This is analyzing content, machine learning, AI, and I know there are a couple of Israeli companies that do the same, but this is, and I'll stop here, as the market's moving away from content to technology, 10 years ago, Israel was not going to be a good player in education because the content takes time and takes dollars. But as you can leverage technology, you can see a lot of opportunities for Israeli talent coming from the army, coming from the universities, to create startups that can one day hopefully be worth $1.7 billion. Thank you.